Welcome to another video in our Impact series. I'm Henrik from Membrane, and this is where we explore how the art and science of B2B sales come together to drive real, measurable impact. Today, we're looking at some foundational aspects of managing B2B sales, performance metrics, and how they work. In this video, we'll focus on metrics like win rate, average deal size, sales cycle, and similar metrics. So at Membrane, we call these effectiveness objectives, not outcomes, nor activity metrics. They may seem basic, but truly understanding how these metrics work is key to having consistent numbers to track the effectiveness of your efforts. Without a clear definition of these metrics, you can't actually benchmark your team. You can't track progress or ROI on training or coaching efforts, and your forecasting will be hit or miss. Let's dive in. So here we see the big picture of it, right? What is win rate? Well, you look at the number of won deals and the number of lost or archived deals during a specific time period. So in this case, we have won 36 deals and we've lost or archived 55. That gives us a 39% win rate. Okay, so far so good. But how do you track this over time? And this is where it starts to get a little bit more complicated. So I've created a list here, a report of the deals that we've won or lost the last year. So let's zoom in a little bit so we can see more clearly what's going on. All right, so here we have a couple of deals. We have a status. All of these have been archived or won. We have a closing date, a value, and an age. So this is what gives us the metrics we need to track things like win rate, average deal size, and sales cycle, which is the average age of a deal you win. Now, let's start to dive in, because when we're looking at this here, it immediately becomes more difficult to see, well, what is our win rate? We've lost a deal, we've won two, we've lost two more, we won one, and then we lost two more, and so on. So at a glance, you could probably start to do some kind of math to say, well, it's a little bit below half that we win. But let's start to break this down. If we group this graph, so I'm going to change this list graph and say, I don't want to see it just as a list like this. I actually want to group it by closing date. And I'm going to first off group it to the most granular level we have. I'm going to look at it daily. And now we're getting into the complexity of it. So I'll save this graph so we can see it a bit more clearly here. What we can see here is this day on March 3rd, we won a deal and we lost a deal. All right. So on March 3rd, we had a 50% win rate. On the next day, we had a 100% win rate. We won all the deals that exited our pipeline, win or loss. The next day, we have a 0% win rate. This isn't helpful, obviously, to track the effectiveness of an individual, a team. What is the return of our training investments if we've sent the team off to a training effort or something similar like that, right? This would be very chaotic. It would be all over the place. So if I scroll down a little bit further, we can see this in a different way, where a green little line here is a won deal and a gray is a lost deal. And we can see here that just on a deal day level, we also have days where we didn't win anything. So that would also make our win rate very bad during those days if we're looking at it this granularly. So to address this, what you need to do with metrics like this to stabilize them into something that is more helpful and practical that you can apply is to start to create a better, more stable data set that changes more fluidly and organically over time. And this happens pretty naturally as we zoom out. So let's take a look at the same graph. If instead of day, let's look at it on a weekly basis. Okay, here we can see now, if I save this again, we now have a little bit more to work with, right? So we have an archive deal. We have 2 wins and three archived in total during this week. So this gives us, right, a 40% win rate during this week. We can track also things like the average deal size. This is the value of the deal. And we can see here the average is 140K. We can see that the average age of these deals that we won during that time is 119 days. Okay, so now we're getting somewhere. We're getting this. This looks a bit more stable. But if you're not winning multiple deals every week, especially as an individual, maybe this is a whole team that we're looking at here, it's still going to have things like this, where all of a sudden we have just one deal that week that was won or lost. And again, we get this very aggressive, uncontrollable metric, right? It doesn't behave in a way that is helpful. So to help do this, what you want to employ is a rolling average. So we saw that it was helped by just zooming out on a weekly basis. And what you'd want to do is effectively to achieve the same result if we zoom out even further and now look at a monthly basis. Now we're going to see a lot more stability in this metric. And if we do this down here on this very jumpy graph that is very hard to spot any trends, we do the same change. Closing date to a week. Okay, now we're starting to see a bit more stability. Closing date by month. All right, that's starting to look like something. Here we can now see that we're apparently very stable in terms of we're winning 3 deals a month. But if we're looking at the win rate here, 37%, 42%, 37, 42, 42, 50%. This is a much more stable metric. But how do you do this when the data you're working with looks like this? And that's where the rolling averages come in. So the way we track it, and the way I would recommend and urge you to find a way to track this is with rolling averages. So if we're looking at a rolling average, it looks at today and then a time span backwards. So what that does, it smears this out and it says, well, we're looking at today, but we're including data that has happened recently in a rolling average that more organically changes over time. This will give us a more stable metric to track if anybody is improving, if they're struggling, if our coaching efforts are effective. It will really give us something more stable instead of that volatile up and down graph that we saw earlier. So let's scroll down a little bit on this dashboard, this report that we have here, and take a look at this from another perspective. So here, we're looking at our win rate as a performance metric that we can benchmark our team with. We can use this as a very helpful metric to track the progress, the development of our team. So here we can see the win rate over the last 12 months. And in this example, we're looking at Michelle Yeoh, one of our salespeople, and we're trying to figure out, is she doing well? Is she struggling? What trends are we seeing? So if we're looking at a context like this, that is looking at a snapshot, we want to see all of the won deals this month versus all of the deals that we lost this month. She would have a win rate of 27%. And that's where this comes in. Why does it then say 40%? Well, that's because we have this rolling average. We can see that this graph, this line here, is very stable, right? It barely moves. And this is something where you also need to tailor that rolling average. How much data, how much time do you want to include in that? Because it gives you control. So the higher volume of deals you have, the tighter the rolling average typically. And if you have longer sales cycles, fewer deals, typically you want a longer time span to be included. So let's take a look at what happens if you change this. And this is something that you in another tool might be, you might need a calculation field, or you may need to do some Excel magic to get to this. So I'm just going to go and show you what this would look like if you were using Membrane. And if you are, you can follow these steps. If you're not, hopefully this gives you the sort of math and the mindset to do this. So I'm going to go into settings, the system setup settings in Membrane, and I'm going to scroll down a little bit to defaults. Here we have a bunch of settings. When does your fiscal year start? What time format do you want to have? But here we have analysis rolling days. How long do we want that time span to be? So I'm going to change this from the longest of 365 days, which would give a lot more slow change in a stable graph, down to the fastest of just 30 days. And remember those numbers where we had 40% versus 27? Let's take a look at what that looks like with a 30-day rolling average. So I'm going to go back to the graph, and we can see this now, because we're looking at a tighter time span, is going to be much closer to that, but unlikely it's going to be the same, because this is a specific month and this is a rolling average. So there will be some overlap and some differences in it, but we can see here that this number now becomes a lot more dynamic. And maybe this is what we want. We want to have this, but I'm going to go and say, well, in this case, it's not that helpful because it's really volatile. It's hard to see a trend and such. So 30 days rolling average makes this very jumpy, and we can control this in by just changing that setting again. So I'm going to scroll down and go to defaults and set this to what I typically find is a good sweet spot of 90 days. So I'm going to change that, go back to the view, and here we go. This is pretty helpful. Here we can see that she was stable here. She had a pretty good, strong buildup over several months here, but she has since struggled to retain that and has moved down to a lower level again. Maybe this was just a hot streak, maybe everything aligned, but now we can start to see there was a trend here instead of everything jumping up and down or being completely flat. And the same logic applies for win rate, lead conversion rates, average deal size, sales cycles, and so on. These types of metrics that you don't want to have jump up and down on a daily basis if you want to see the patterns that your team is facing, if they're having struggles, if you're spotting individual differences. Maybe one person's win rate moves up, the other one person's moved down. Why is that? You need a stable metric that you can control and adjust to your business so that you can reliably track this and coach your team, hold them accountable when needed, but mostly be able to reliably track the effectiveness of your efforts. I hope this was helpful, and I'll see you in the next video.